Hey, soldiers, stop spending money right now. It is time to curtail spending. Reason why I'm saying that is because Goldman Sachs has just put out a forecast, and we can support this with what we know is going on. Goldman Sachs just put out a forecast saying that they're expecting between 5 and 10,000 jobs to be lost every month starting in 2024. Guys, I really need you to share this message. People need to know this, okay? So share it. Just hit that share button. Send this to family and friends. Also, need you to hit that thumbs up. That way, the YouTube algorithm will also work to spread this message to a wider audience, okay? I think that we're really in, I'm not going to say dire straits here because we're ahead of it. We know now what's going to happen with a reasonable degree of certainty. Again, some will castigate this video as doom and gloom. It is not. It is a forecast. If nothing happens, then great, we're prepared. But I live by this axiom. Hope for the best, expect the worst. Okay, so we got to plan for the worst case scenario. If we get that, then okay, we can deal with it. If we don't, then it's all gravy. A $2 trillion corporate debt wall will spark job losses in 2024, Goldman Sachs says. Now, they're strictly looking at corporate debt. Keep in mind throughout this entire video, we got corporate debt, we got student loan debt, 1.7 trillion, and we've got credit card debt, over $1 trillion, okay? So we've got some real pressures on this economy. Now, what did we just see Jerome Powell and the Fed do? They did not raise rates this last go round because they know that we've got the $2 trillion in corporate debt, close to $2 trillion in the student loan debt, and the $1 trillion and rising in credit card debt. Okay, so they know this economy is slowing down outside of just interest rate pressure. A $2 trillion corporate debt wall. All right, Goldman is estimating that the economy could shed 5,000 jobs per month in 2024. That's just the start of things. The bank said on last Sunday, that higher interest rate expenses tied to the refinancing of corporate debt will lead to a reduction in capital expenditures and a shedding of about 5,000 jobs in 2024 that could double to a loss of 10,000 jobs per month in 2025. We're talking about per month job losses. If they're half right, all right, if they're half right, we are in some very turbulent waters. Now, this assumes that the interest rates remain elevated at their current level. But what have I been telling you guys? I've been suggesting that the Fed is going to pause on increasing rates and is going to start lowering rates at some point. Now, we're heading into an election year, right? Okay. You're crazy if you believe that the Fed, Jerome Powell, is not susceptible to influence from the White House or from Congress. A lot of these people are going up for re-election, right? At the end of the day, he's going to act independently. But Jerome Powell, he says, hey, this Fed thing ain't going to last forever. I need to, feather my nest for, post-Fed chair position. And he's not going to want to alienate too many people by having them risk their political futures, okay? Because remember, all these politicians, even if they're not in office, they're still going to be pretty powerful people in the positions that they occupy subsequent to public office. Be in a position to, kind of help Jerome Powell out. This is how it works, guys. I was in D.C. I know. Sounds incestuous because it is. Now, if the Fed does what I think they're going to do, and because of situations like the corporate debt, and don't forget, the federal government itself is liable to higher interest payments on the national debt as long as interest rates stay elevated. I think that they're going to start to lower those rates in order to relieve those pressures. Now, don't rejoice, because when they do that, it will keep inflation rising at an elevated pitch. All right? and that will affect us. Yeah, the onus will be off of corporations. The federal government will get relief from the interest payments on the debt, but we'll be stuck with even higher prices. We're in a no-win situation unless we take the reins, stop spending, okay? Stop this car, all right? And break out the roadmap and let's figure out an alternate path. If interest rates remain high, companies will need to devote a greater share of their revenue to cover higher interest expense as they refinance their debt at higher rates. Goldman Sachs' Jan Hatzius said, "We find that for each additional dollar of interest expense, firms lower their capital expenditures by 10 cents and labor cost jobs by 20%. U.S. companies benefited immensely from the period of low interest rates before 2022. This is according to Bank of America. The debt composition of S&P 500 companies includes a whopping 76% in long-term fixed debt, much of which was secured at low single-digit rates." And we know that, that situation has changed. Interest rates are impacting the housing market, making it more expensive for people to go in and get homes, because in certain markets we're not seeing a corresponding decrease in price. But as interest rates stay elevated and potentially go higher as the Federal Reserve continues to combat inflation, again, I don't think that's going to happen. I could be wrong, okay? Refinancing risk will grow more pronounced, especially over the next 2 years. Guys, that is why I'm saying stop spending now, okay? Look, that vacation you had planned, unless it's already booked and paid for, rethink it. I know here, okay, let me give you an example. Right here, we were going to do a whole revision to the landscaping here, and it's not cheap, okay? But we were going to get it done. It needs to be done. But is it going to get done now? No, we're holding off. Now, let me explain to you, by me doing that, that's going to have an impact on the landscaper. That's going to be some money he's not going to get right now. And that may impact jobs of the people that he has employed. It's all a downstream effect that you know very, very well. The companies that will be hit hardest by refinancing debt at higher interest rates are unprofitable companies, as they have a tendency to lean more heavily on firings to balance debt. So some of your tech companies, some of these new startups are going to feel the pinch because right now they're just getting started, or some companies that are marginally profitable. That means they don't make a profit each and every quarter. Our estimates suggest about half of the reduction in labor costs come from reduced hiring and half from lower wage growth. So reduced hiring, they're not going to be creating as many jobs, and lower wage growth, meaning raises, if they occur, are not going to be anywhere near something that would meet or beat inflation. This implies a 5,000 drag on monthly payrolls growth in 2024 and a 10,000 job drag in 2025. The debt refinancing wall helps illustrate why it could take years for the Fed's aggressive interest rate hikes to make its way through the economy and impact business. And that could explain why economic recession has not yet materialized. But hasn't it? We are seeing a slowdown in our ability to spend money because we're getting less for the same amount due to inflation. We are starting to see some of these jobs, some of these companies pare back on hiring. The Christmas shopping season, it's forecasted that there won't be as many temporary jobs created for that season as you might expect in a normal economy. The limited refinancing needs since the start of the Fed's tightening cycle suggest that the impact of higher interest rates on growth is more delayed than the average historical impact that our financial conditions index impulse model project. And the reason for that is these models are not going to apply when there's a lot of cooking the books. We've seen that they've changed the definition for recession. They're monkeying around with the inflation numbers. We're not seeing true inflation unless we look at something like John Williams' shadow stats. Also, the jobs numbers, we've reported that each month in 2023, we've seen a revision after that first number was published. That's impossible, folks, unless, and the revision has always been down, okay? That's impossible unless they are cooking the books and putting a rosy number out front and then coming back later and saying, oh yeah, by the way, that was down, when the news cycle isn't paying attention to the revision. Guys, ant and grasshopper time. Squirrel away that money, okay? Put it on the side. Watch our emergency fund video right here so you can understand how you might want to roll going into these turbulent 2024 and 2025 periods where we might see a tremendous reduction in jobs and further stagnation of the economy. Guys, I'll talk to you soon.